22,500 is here. As we open, the Nifty is 22,495. That's the opening. 513. There you have it. 22,519 for the Nifty at the high point, where the mid-cap index is doing better. The Nifty Bank just about in the green. The top gainers on the index, we have the likes of ONGC doing well, Apollo Hospital, a couple of steel companies. The top loser, though, is M&M. Promoters selling some stake out there. ICICI Bank is seeing a wee bit of sell-off after a big day in yesterday's trading session. Some of these oil marketing companies, BPCL, etc., lower too. In the broader markets, there are way more stocks advancing than the number of stocks which are declining. But the ones which are declining are, very specific in nature, belonging to the city gas distribution space itself. IGL down 4%. We have Gujarat Gas down about 1%, but 22,500 on the Nifty.
Okay, by the way, I'm looking at a lot of these steel stocks that are rallying. We've got China's trade data out, and it's better than expectations. I think it's a straight out play. I mean, there's a sentiment rub-off. And metals is a sector of choice today. JSW Steel, Hindalco, Tata Steel, all of them are reacting quite favorably. At this point in time, there's a bit of a leg up on Bajaj Auto that's continuing. Some buying on a lever and a State Bank of India. But then after that, it starts getting a bit quiet, really. By the way, HDFC Life, Prashant was just discussing this with Deepa in the fact that surrender value regulations will probably not be as onerous and as hard-hitting as what was earlier feared. That is working well for some of the life insurers. M&M is down, talking about that block where promoters are selling some stake. And then you have the big boys. Big boys are actually just sitting out, maybe already in weekend mode. So Reliance, TCS, Infosys, ICICI Bank. A lot of these stocks are negative. And Prashant, that bank trade that we're speaking of, at least the big one that started yesterday, no sign of that continuing this morning. Very quiet on the Nifty Bank.
No, absolutely. And, we'll see. I mean, that's the thing, right? Lots of false starts is what we've seen with the Nifty Bank. The big underperformer within the underperforming banking sector, which is HDFC Bank, did not fire. I mean, it was flattish to slightly higher. It was ICICI, IndusInd, Kotak, Axis. I mean, those are the ones which actually did well. So let me just quickly run through a few other broader market names here in terms of what they're doing. Let's just look at the two casualties from the last 2 or 3 days, IIFL Finance and JM Finance, and see what's happening there. The names should come up on your screen.
Up 70%.
Yeah, I mean, there is some sort of buoyancy here, right? I mean, so 8% up on IIFL Finance, 400 plus is what we have. Yesterday, of course, we had Prem Vatsa Fairfax committing sort of, in a way, showing support. So support for $200 million for the IIFL group. Of course, we don't know what shape, form, debt, equity, etc. But that's a strong commitment from a very large investor. And it's an entity which has got investments in all IIFL entities, finance, securities, 5 Paisa as well. So that's up strongly. JM Finance, if you can have that up, take a look at what's happening there. It is...
flattish, JM Finance.
Okay, it's flattish, not very much, about 1% up. Just a few other names, right, in the broader markets. Let's start with RBL Bank. RBL Bank had sold off day before yesterday sharply. It's got huge volumes. It's up 2.5% right now. Sirma is another one, which is the EMS company. 6% on Sirma. Humongous volumes, 552. Third largest volumes right now. Look at Chola Finance, 3% higher, 1,051. And again, I'm just spotting this because it's got large volumes. Surabhi was talking about steel. JSW Steel is up about 2.25%, 2.33%. There is Aavas Financiers, which is up about 3%. I think it's done well recently. Tourism Finance Corporation has been selling off last couple of days. TFCIL. Otherwise, generally, it's done very well. Is 3% on it. Data Patterns is another name which has done quite well. It's up another 2.5%. There's JSW Energy, which is up about 1.6 as well. IIFL Securities is up about 6.5%, 7%. So that's the other IIFL group company. Paytm is back at 400. I think it had fallen about 380 or so, back at about 400 right now. And then you go down the list, volumes are missing, so I won't. I'll probably wait a little bit. SBFC is down 10%. I'm not sure what the news is, but we had the management with us yesterday. I mean, around the same time. It's a fairly recent listing. It's not done very much since it came to the market. Run by a very veteran, well-respected banker, Asim Dhru. But 9% cut. Look at volumes. 4 crore shares. Almost 5 crore shares traded on SBFC. After M&M, it's the second largest volume traded name that you have. And then the gas distribution companies, Mangalam. IGL is down 3%. And I can't spot MGL as of now, but IGL is coming up with volumes on the downside.
MGL is quite flat. I just want to mention one point on Sirma, since you brought that up. That's a CLSA impact. CLSA likes the stock. They've initiated coverage.
Yeah.
Target price they've given it is around, I think, 640 thereabouts. And I think 22% CAGR top line growth is possible by this company. So that's a brokerage impact.
Well, just a couple of stocks. You spoke about RBL Bank. Yesterday's interesting bulk deal data. They told you that Matthew Syriac, who's, a former Blackstone executive, he bought about 0.5% equity in the large trade that took place in RBL Bank. So maybe that's the reason why the stock is up about 2% The other one that I'm looking at is Jupiter Wagons 2. That was lower in yesterday's trading session, but then they got an award worth nearly 1,000 crores coming in from the railways, and that stock is up around 6%. So those are a bunch of stocks. The market opened about 22,500, sold off a bit, but now still holding up mildly in the green, just below that 22,500 mark. What's good today is the mid-cap end of things. After 4 days of the broader market seeing more decliners than advancers, we have nearly 3 stocks advancing for every 1 stock which is falling today. So 1,500 stocks on the NSE which are gaining for about 450 stocks which are on the red side.
Absolutely. And, we'll sort of track that ratio because it's important, right?
Yeah.
A divergence can continue. I mean, large caps can go one way and mid caps and small caps can go other way. And that can continue for a while, but not for very long. We'll track that. The market is at about 22,478, absolutely a flat line. Remember also, of course, that tomorrow is a market holiday. US will be trading, so you'll be reacting to 2 days worth of data when we come back. 2 days worth of market reaction as well when we come back on Monday morning. Ravi Dharamshi is with us. He is our market master of the day, Chief Investment Officer at ValueQuest Investment Advisors. Ravi, good morning. Great to have you with us here. Thank you very much for your time. It's been a while, so good to see you back on the program. Ravi, broader markets are kind of, seeing a little bit of pressure, a little bit of pause. We've kind of seen sort of the market regulator, SEBI, expressing, and their words, calling it some froth in the market. RBI, of course, also coming in a different way, very specific instances. It's not a broad kind of brush. But many are taking this to mean that the regulators want things to kind of cool down a little bit. It's just too hot. Is that the way you look at it as well? That is one, from how you perceive some of this action, and what's the course ahead in the near and medium term for broader markets, mid and small caps. Go on, Ravi.
No, I think both the regulators are doing a fantastic job of anticipating which could be the possible trouble areas. And I would say it is much required. And if we can cool down a little bit in those areas right now, maybe this cycle can continue for longer. But of course, see, whenever you paint something with a broad brush strokes like mid and small cap, mid cap is 150 companies and small cap is 250 companies. So obviously, it's not like every company in that basket is going to suffer necessarily. There are going to be some companies where performance will still uphold the valuations. And valuations are not necessarily the only reason why markets can fall. I mean, it's a prerequisite, but it's not necessarily a sufficient condition for the market to come down. So outlook remains good. And we have just seen that one of the RBI, which is one of the most conservative regulator, and they have upgraded their numbers and they feel India will grow closer to 8%. So that tells you that there is a lot of buoyancy in the economy. And in a rising economy scenario, the spoils tends to be shared by more and more number of companies. So it's a natural phenomena that more companies will do well. So from that perspective, on one end, you're saying economy is doing well, and on the other end, you're saying a mid and small cap, there is a froth. It's not totally unjustified. There will be pockets where there will be some fun and games. So it's good that regulator is stepping in and kind of cooling down things.
All right. Ravi, what are your thoughts on some of these themes? What is it that you're liking? What is it that you're avoiding at this point in time?
So, see, the challenge in the market is that themes are pretty much well recognized. It's not like there is any particular theme that nobody has ever looked at. So you have to go with one that is facing some cyclical challenges. So consumption is one space where we are facing some headwinds since last some time, and numbers have been really deteriorating. Chemicals is another space where the numbers have been disastrous in the last few quarters. Now, I'm not saying that this is necessarily the space where one should be investing, but I think the relative valuations are starting to get attractive, and probably the worst of the performance is starting to get factored in. So these are the areas where one should probably start looking, is what I feel.
I think we've just lost that line. Yeah, sorry, Ravi, continue. We lost you for a bit over there. You're saying that consumption has underperformed. Are you suggesting that you will start looking at that space now?
So, as I mentioned, that performance might be bottoming out. See, it's an exact timing nobody is able to do, but I feel valuations are starting to get attractive, and consumption remains a longer-term theme in India. It cannot be written down. If we are to go to a $5 trillion economy, our disposable income, our per capita income will rise to $4,500, and at that level, the discretionary consumption boom in India will really be going hammer and tongs. So, in anticipation of that, probably next 6 months are a great time period to be looking at some of the consumption bets. So it's a little bit of a contrarian bet, and we could be early right now, but I feel that that is the space to be looking at.
So consumption, are you going to stick with discretionary, or would you play rural? Because it's all very confusing. I mean, even in rural, two-wheeler sales have been going through the roof, but your typical FMCG has been underperforming, and then there is discretionary where stocks have already run up. I mean, look at what's happened to real estate stocks, for instance. So what part of consumption would you play, and through what sort of companies?
See, the hockey stick growth can come only in the discretionary side. On the staples side, it is difficult for us to witness this, whatever 5-6% growth going to 10-12% growth is very, very difficult. Also, it depends on the penetration of that category. Something like toothpaste has 70% plus penetration. We are not going to see a huge jump over there. So as we move up the hierarchy of needs, more spend is done on experiences, services, goods and luxuries that were beyond our reach earlier. So naturally, we will the premiumization story and the higher value products where the discretionary spends are the ones that will benefit disproportionately going forward. So we would continue to look at discretionary.
You're bullish on financials. What is it that you like out there? Is it the PSUs? Is it the private large banks? Is it the NBFCs? What is it that you like?
So as I mentioned, the challenge is that whatever we like and where the tailwinds are strong is already identified by the market and is kind of priced for perfection, if I may say. So finding an opportunity where you can generate alpha in those spaces is challenges. So whether it is capital goods, manufacturing, some of the capital market beneficiaries, those are all going very, very strong. And where the opportunity lies, there are obviously some headwinds. So those headwinds still need to play out and valuation still need to correct. While where the tailwinds are there, some amount of maybe further overvaluation cannot be ruled out. But so that is the scenario that we see ourselves in. What is well recognized might get really overpriced going forward.
Ravi, there's a lot of activity in the SME space as well, right? And there are lots of good companies coming up as well. And you're bullish on renewables as a space, as a theme, right? That's the big bet: electrification and renewables. And there are lots of ways to play it now. A lot more as compared to 2-3 years ago. Do you remain as bullish there? And have you done anything new, if you can share with us?
So what I'll tell you is that, this space is still very much in its infancy. The sector is just getting born. The energy transition as a theme is likely to last decades, not next 1-2 years. So from that perspective, these companies are still very, very small. Having said that, there is hardly any representation in the public markets of these companies. So the action right now is probably more on the private side or companies that are now looking to get into the public markets. So challenge for a lot of these companies maybe about 18 months back was that IPO market had completely shut its door. So when they wanted to do an IPO, they could raise funds. So some of these companies did a private round. And that now rub off is obviously that now the public markets are also doing well, and there is exit available for anybody who wants, or there is ability to raise funds in the public markets is far, far higher. So some of these companies will come to the market, new sectors will find representation in the market. And that I think is a really exciting space from that perspective. Surely valuations we will have to see case by case. But new business models do excite us because they don't have representation on the public market side as of now.
Have you participated in the sort of rally in NTPC, BHEL, Power Grid, and the other stocks, the traditional, largely thermal coal power stocks?
So without naming any particular company, so we do like the energy transition theme, and in the energy transition theme, our preference lies more towards power equipment and shovel sellers. So our hypothesis is if there is a gold rush, always back the guy selling the shovels. So that is why we focus more on the equipment providers. So energy, power transmission equipment is one space where we really believe that in next 5 to 7 years, there is going to be a major boom. And we are definitely going to stay invested in that particular space.
Ravi kept saying that he's looking at newer business models more than anything else. And this is publicly available information, Ravi, that in the last 1 year or so, the purchases that you made included the likes of CMS Info Systems. There was Zaggle prepaid stock that keeps hitting new highs. And then he liked the chemical space as well. So there's Ami Organics, which was there as a large trade disclosed, purchase as well, and Blue Jet Healthcare. Your thoughts on these, names / themes?
Actually, Zaggle, I'm very interested. I mean, when it came, I remember I spoke to the company the day the IPO was opening, and I said, well, it was like Sodexo, but now, slowly you kind of realize it's actually a lot more. It's a lot more in terms of what they do. But
Ravi, CMS and Zaggle in particular, this is publicly disclosed information that is there.
No, as I mentioned, I will not be able to speak in particular about any company. But what I can say is that these are all our investments, and we continue to hold them and like them. Some of these are beneficial, we already mentioned, like chemicals is a space where we believe that pain is probably a couple of more quarters, but going ahead, the space continues to look good. Also, fintech as a space sometimes it seems to be in trouble at this point of time. So there are very few profit-making fintech companies out there. So Zaggle actually is one of those few profit-making companies in this space, and it is not in the lending space. It is more, at the back end of helping the banks in the customer acquisition for the credit cards. So from that perspective, it's a fee-based model. It's a SaaS-based model, and pretty much immune to whatever has been happening in the space. So, without giving any kind of a recommendation, but these are spaces where we are invested and we continue to like them.
Okay. All right. Ravi, great to have you on the show. Thank you very much for joining in and giving us perspective on the market. The market's absolutely flat, actually, with a bit of red now on the screen. And mid-caps are actually doing slightly better. I just want to point out some stocks. Very interesting move on Tata Chemicals. And this is continuing from yesterday. It was up 5-6% yesterday, put on another 6% this morning. So that's interesting to look at.
Third day in a row, Surabhi. It's up 28% for this week itself at a time when the mid-cap index wasn't doing very well.
Absolutely. Clearly something up over there. Then there's Jupiter Wagon, which is reacting quite well to an order announcement. They've got an order for around 900 odd crore rupees. Data Patterns is up and about. So these are some of the stocks that are hitting the headlines. But the big headline this week really has been the regulatory action that we have seen from the Reserve Bank of India when it comes to several NBFCs. So that has been, of course, the talk of town. JM Financial Products and IIFL Finance, these are the two entities in question where we saw the RBI come out with some very, very stringent measures. So what does this tell us, and what is perhaps the road ahead looking like? Is this a sector-specific phenomena? Is it an entity-specific phenomena? How should the market read this? We have with us Abizar Devanji, partner and national lead of financial services at EY India, and former RBI Deputy Governor S.S. Mundra. He'll be joining us in the next couple of minutes as well. Abizar, great to have you on the show. Thanks for joining in. What have you made of all the headlines and the noise over the last 48 hours or so? Because what we've seen is the RBI pretty much sharpening its stance and stopping companies in their tracks, literally, whether it was the gold financing business in the case of IIFL or loan against shares in the case of JM Financial. Your thoughts?
Yeah, firstly, it's not a 24-hour thing. I think it's been happening for a while. IIFL happened, over the last week. JM happened in the last 2-3 days. We've been seeing what's happening with Paytm on the KYC side. I think one is the larger concern that RBI seems to have, and I say this seems to have because clearly I'm not privy to the real facts, but from what it appears from the outside, is that I think there is a concern around the systemic risk build-out that's happening on the retail side. And I think more than justified in terms of the way people are being given loans or forced into loans. Some of those land up into consumerism, and hence repayment could be an issue once we have an income issue. So really, I mean, RBI seems to have realized that what is a loan? It's just discounting of future income, and the future income seems a little uncertain, and which may be on the large part of the retail. Then, in the quest for growth, should people be allowed to give credit, which will ultimately form systemic risk? And I think that is at the core of any of these actions that you see, whether it's KYC and multiple Paytm accounts being opened on the Paytm side, or whether it is issues around valuation of collateral for IIFL, or whether it's loan against shares being offered to people, significantly leveraging an equity market product that JM was offering. I think those are the issues. It's a larger concern, and RBI wants to make sure that the process stacks up and we don't have a larger systemic issue. That seems to be the basic concern. How justified it is, frankly, will be more towards the specific of every case.
No, absolutely. Abhizar, hi, good morning. From a capital market, equity market point of view, right? So in terms of interpretation, Mr. Mundra is also with us. So let me actually welcome in Mr. Mundra and sort of get him into the discussion as well. Mr. Mundra, from an equity market point of view, many are seeing what we've seen from the RBI, action and sort of messaging to a couple of NBFCs to mean that the RBI wants to cool capital market funding in that sense, right? I mean, things are getting a little too hot. Would you go that far and say, well, that is what they're trying to do? And then there are others who are saying, well, SEBI, the equity market regulator, also kind of in a letter to Mutual Funds Association, AMFI, said that there is some froth building in mid and small caps, right? That coming from the regulator is quite startling. So is there a kind of, would you say, and since you've kind of, you would know how this works, is there an attempt by regulators together to cool in the very hot equity markets? What's your sense, sir?
Is it a question to Abhizar or to me?
To you, sir, Mr. Mundra.
Okay. No. I think what an interesting kind of correlation you have brought out, which I think, frankly, I would not even think about it.
No, it's not my correlation. It was just, I wanted to put that to you because many are, there's actually an opinion piece out there which kind of makes that correlation that maybe, there is exchange of information and they're trying to, because, I mean, now equity markets are so large, they're an important piece of what we call financial stability, right?
So let me give you my perception. Number one, to begin with, I don't think that there is any such thing like this, that both the regulators are talking about the equity market. And see, we are talking about one particular sector in large BFSI space. Within that sector, couple of entities, and that is a way to cool down the market. That's not the way, and that is not how the RBI works. I think as Abhizar was also mentioning just some time back, and if you go back and look at some of the macro data, there is enough hint in FSR, financial stability report of RBI also. I think those are all the concerns because globally, what they call is NBFI sector, that is the non-banking financial intermediary. NBFC is a very typical Indian term. So globally, Financial Stability Board, which is the G20 body, had also been concerned about the share of NBFI in the overall, the financial sector. But within that, the NBFC, the lending entities, I think India is one of the highest share, having maybe something like US, UK, and India. The second thing, the last year, the FSR report, if you look at it, September 23, the credit growth in NBFC had been something like 21%, which was around 11% in the immediate preceding year. More importantly, personal loan in NBFCs in last 4 years have, increased at a CAGR of almost 33%, whereas the credit growth in the system had been 15%. So I think for any regulator, then within personal loan, the components, concentration of risk in any particular sector. So I think for any regulator, these are some of the macro indicators which prompt the policy action. So that is on the policy action or on the macro side. When you come to the micro side, individual entity, then of course there is an inspection, there is a regulation with the company, and you must have seen nothing has happened overnight or nothing has happened in a month. I think there had been engaged in dialogue, there had been inspections, the opportunity has been given to correct. This is from where I think all it comes.
Sure. Mr. Mundra, sir, good morning. If I could just ask you a follow-up question. I think...
let me wish you a happy Women's Day. Then we come to the question.
Thank you so much. Really appreciate it. And I'll extend that wish to all of us, all the women here at CNBC-TV18, and of course all our viewers as well. But sir, just to come back to the point, I mean, I think the RBI's intentions have never been doubted. I mean, they're out there to put the guardrails in. And we've seen that happen, right? When the risk weights went up, that was the first step on unsecured lending. And now what we're seeing in specific NBFC segments. I think a question that was also doing the rounds yesterday, that while RBI slams the brakes, and in some cases it has been absolutely immediate, I mean, from the very next day, because financial markets are interlinked, could it lead to any kind of other accidents? I mean, I don't want to go back and compare this to 2018 and what happened with NBFCs then. But for instance, yesterday, one of the entities where there's been RBI action, one of the investors had to come in and say that we're putting up $200 million as a line of liquidity, just to ensure that there's no breakdown in market confidence. What about the collateral damage and the ramifications of what is perhaps much needed RBI action?
See, as I just mentioned, you said that, okay, they issued the directive today and it is applicable from tomorrow. But what I have been trying to tell you, and I just mentioned, that this would have been something which was in making for quite some time. If you, I won't name any individual entity, but you take the first instance where RBI took action a month back. And if you look at the history, it was somewhere in March 22 that the first action was taken. That, okay, don't onboard the new customer. And now we are talking about almost 2 years from that date till now. And there must have been dialogue, there must have been report, there must have been follow-up inspection. I'm sure it must have been the similar cases in other things also. So, number one, what I'm trying to say, no action by the regulator, RBI, at least I can tell you with little bit of let's say confidence of insight. There is nothing like abrupt action. There is nothing like ad hoc action. Enough dialogues happen. And I think in whole scheme of things, as I said, a large financial sector, within that a particular sector, within that couple of entities, and even within that entities, couple of their portfolio. By no stretch of imagination, I would think that it can lead to a systemic risk or a collateral damage or a kind of, turmoil in the market. Yeah, there could be impact on individual entities, but then yes, if it has been making for such a long time, I think it was required to gear up. Though there are difficulties in doing that also, if we have time, maybe I would comment on that.
Right, we take that. And, what you've said, I'll just paraphrase what the RBI governor said in the last monetary policy meeting as well. And this was with regards to the questions around Paytm, where they said that it was supervisory action for persistent non-compliance, and they had been engaging with the entity for a very long time. And the RBI does give sufficient time for entities to comply, and at times even more than sufficient. So those points are well taken. Abhi sir, from a company standpoint, what is it that they should be doing to perhaps, not run into this regulatory risk? Because there's this constant tug of war where the market wants growth, the kind of valuations that these companies are trading at, the kind of funds that are chasing these companies at the valuations that they're trading at. They're tempted to do something which may hurt, the regulatory things here. So how does one navigate through this tug of war? What is it that people like you can advise to them?
So there lies the problem, as you rightly said. that it's the question of growth getting stifled a bit. And that's exactly possibly where the regulator is saying, halt, take a pause, and figure out what you're doing to whom. And frankly, a lot of the stock price drops that you're talking about are happening not because there's a liquidity crunch. It's great for somebody to come and reinforce that, oh, there is liquidity available, but there is not a liquidity problem. The problem is that of growth. And frankly, what an RBI or any other regulator would want to say, let's not have unabashed growth, where customers are getting lured into risks that they are not aware of. And there is a consequential impact of that on the systemic risk. So if you put that into perspective, I think should growth be paused in some cases? Yes. Now, what's happening on the banking sector, or the financial services sector? Banks are also trying to chase growth. Banks have an inherent advantage of their cost of deposits. They are trying to go and pitch products which were here into NBFC's domains. NBFCs are pushing themselves further down that track, either into more ignorant customers or compromising on collaterals and getting their own growth done in a particular fashion. Now, what is happening in this whole thing is India is getting more and more consumer debt laden, and that itself could cause a systemic risk. And what the RBI is trying to say is that while it may not kind of collapse the financial system, let's make sure that there is enough safeguards being put in so that the right kind of credit gets offered. I think that is what the growth will get stifled. I also think, frankly, a similar action will now be taken by the banks themselves to make sure that their own KYC processes are better. Every other NBFC which has not been targeted until now is actually relooking at their processes anyway. So in a way, making these things exemplary, others are also trying to cut down. So while the stocks of these two companies may be going down, I think others should go down too, because growth will get stifled across.
The signaling impact is quite powerful as well, right? But a great conversation with both of you, Mr. Mundra and Abizar. Appreciate you joining us here in the program. I've said this before, the regulators, of course, have much more data than you and I and generally all of us have. And they've been extremely proactive. And, I remember the RBI governor a couple of months back, this was late last year, he said financial stability is a public good. And we've kind of fought hard for it, and we will protect it at any cost. And I think perhaps a lot of this individual kind of instances should be seen in that light as well. The markets, by the way, absolutely flat, 2-point change or so. We'll take a quick commercial break here. Anil Gupta of KEI Industries will join in and we discuss business with them. We'll sort of get more micro here. And of course, after that, we'll have the management of Suzlon also joining in. The government's decision to bring back reverse auctions. That's the topic of discussion. Stay with us.
Mid-cap's doing well. The frontliners absolutely flat. Let's talk about the exclusive story, which is at the bottom of your screen. What we understand is that the government has granted an extension to the FAME 2 subsidy scheme. Parikshit joins in with these exclusive details. Parikshit.
Well, there was a lot of uncertainty in the industry for the last few weeks about what is going to happen to the FAME scheme, whether it will expire on the 31st of March, whether there will be a FAME 3 scheme or whether there will be an extension. We have now got to know from our sources that the government has very recently granted a 500 crore rupee extension to the FAME 2 scheme. The scheme was expiring on the 31st of March. It's been extended for 4 months till the 31st of July 2024. And this 500 crore extension will be to cover incentives for electric two-wheelers and three-wheelers. The government has done this in order to avoid any disruption of the electric vehicle ecosystem. At the same time, the Ministry of Heavy Industries proposal for a 10,000 crore FAME 3 scheme has received some support from the Expenditure Finance Committee in principle, but this proposal will take time. It will have to be brought before Cabinet, and this is unlikely to happen till the elections, the Lok Sabha elections are over. This 500 crore outlay, which has been signed off, will be adjusted against the overall outlay of the 10,000 crore FAME 3 scheme once it is approved by the government after elections. So this will bring a lot of relief to two-wheeler and three-wheeler manufacturers in the country, because any disruption of the FAME scheme for a 4-month period could have led to a spike in prices.
All right, take that point, Parikshit. Thank you so much for joining in and bringing us those details. Just a word on a couple of stocks. We've been talking about Tata Chem and the metal space since morning. Tata Chem is up 7% right now, but not only is the stock higher, what's also increasing is the open interest positions on the futures and option space. And now as we speak, the open interest is close to around 111% of the market-wide position limit. Stocks go into F&O band once that crosses 95%. So there is a very strong chance that Tata Chem comes into F&O band. So that's something you need to keep on your radar. The other one is SAIL. SAIL as well has seen a spike of open interest to the tune of almost 6 or 7 percentage points. So that is another stock that may come into F&O band. So those are a couple of stocks that we will keep on our radar. But let's move on. Let's get a conversation going with KEI Industries. The stock has been an outperformer with a near 100% surge in the last 1 year. Q3 was good for the company. They guided for a 17% revenue growth for the next few years. And the first 9 months, they've done 17% itself. How's the business momentum? The outlook from here on? Anil Gupta, who's the chairman and MD of KEI Industries, joins us now. Thanks a lot, Mr. Gupta, for joining in. You've done well. 17% was the guidance. 17% is what you've delivered so far. And with all likelihood, you're probably ending this year at 17% as well. So the question then is that with the elections, with the ordering activity, with all things infra, what are your thoughts for the kind of order intake that you are planning for FY25 and the revenue target? At the same time, a comment on raw material prices.
Yeah, good morning to you. Thank you very much for inviting me. As earlier guided, we will continue to grow at this pace next year as well, or in if coming few years. We are focusing on not only Indian market, the Indian domestic market, but also substantially on exports, which has grown substantially in this financial year. I think this year we should be ending at growing exports by almost 100% compared to last year. And the traction is quite strong in the next year as well. Even in domestic market, we see a reasonable and very good growth from the markets, and the order intake is continuously improving month after month. So I don't see much challenge. We are at the moment building up our capacities in our existing plants, and also the new capex has been taken up for our new greenfield facility, which should allow us to grow at this pace.
So you've guided for, I think, about 15 to 16% growth in the new financial year as well, FY25. Does that take into account the new capacities that will come on stream? Or could the growth be higher? Can you hear me, sir?
Yeah, now I can hear you. Yeah.
Okay, I'm saying you've guided for 15-16% growth in FY25 as well, I believe. Does that take into account the capacities that will come on stream, the new capacities? Or could growth be even higher If you could just, give us the capex plan and the commissioning plan for FY25.
This growth will come from the capex we have done in our existing plants in Pathredi and Silvassa, and the new greenfield facility should bring revenues in FY26.
All right. And, on the product mix itself, I wanted your thoughts. The EHV cables give you higher margins, if I remember correctly, and high tension cables as well. So what is the likely growth in these high margin products going forward? Will that be higher than the 16-17% that you're guiding for on an overall basis? And margins as well. You did see that there could be scope for improvement to the tune of almost 50 to 75 basis points. Next year, do we see margins at around 11-12%?
The growth in this segment will also be similar in nature as I'm guiding, because no new capacity will come up next financial year. So far as margins are concerned, we have guided EBITDA of around 11%, which should be maintainable.
And this 1% price increase that you had said you will take from the start of FY25, that's still on the cards, right?
We are continuously doing. I mean, marginal improvements we are doing in the prices in our retail pricing, especially in the housewire segment.
Okay. All right. So thank you very much for joining us. Appreciate you joining in here on the program. And it's a pleasure, sir. Short conversation today, but really appreciate you joining in on the show. Well, let's just talk about the other big story, right? This is, of course, the wind power sector. Stocks, of course, have been under a little bit of pressure. This after reports emerged that the center has written to states and essentially asked them that new tenders which are bid out, they should do it under the reverse auction mechanism. Now, this, of course, was there a couple of years back, and then we moved on to a closed bid mechanism, and now it's making a comeback. Markets are worried. Let's ask someone who knows the sector inside out. Suzlon is the company that we are talking about. We have Mr. JP Chalsani, CEO of the company, joining in now. Mr. Chalsani, good morning. Great to have you back on the channel after a while, sir. Good morning, Prashant this side. Just explain to us, sir, put this in context for our viewers. If reverse auctions were to come back, is this a big negative or do you think it's manageable? Put it in context.
Yeah, Prashant, let's look at it from the point of the facts, numbers. Okay, that would tell you at the end of it whether it has an impact, has no impact. As we speak today, there is 9 gigawatts of bids which were finalized, awarded to the IPPs. They in turn finalized the OEMs. They are under execution. 9 gigawatts orders are under execution, which are not yet commissioned. On top of it, about 3 gigawatts of orders from the C&I segment, which is commercial industrial segment, is under execution. There is 12 gigawatts of orders which are with the OEMs are under execution, which has nothing to do with the current reverse auction notification. Point number 2 is that in addition to this, there is about 10 gigawatts of bids have been finalized and awarded to various IPPs through the bidding process. These 10 gigawatts is not yet been finalized. They are not yet finalized the OEMs, which they are in the process of finalizing the OEMs. Different in the next few months they would finalize. Plus about 5 gigawatts of C&I segments is under discussion. So in addition to the 9 gigawatts, what I said, 9 plus 3, 12 gigawatts I said, under execution, there is 15 gigawatts of orders being discussed in the market. Again, this has nothing to do with the reverse auction. So we're talking about 27 gigawatts of orders, bids. On top of it, today there is about 15 gigawatts of bids final are declared by the government. In that, 13 gigawatts are non-wind, which are basically FDRE and RTC, where reverse auction was always there, will be there. There is no change in that. In this 13 gigawatts, the wind component would be 13 gigawatts because in case of FDRE bids, which are the fixed dispatch renewable energy bids, if the PPA is for 500 megawatt, your wind component would be 1.2 to 1.4 times. Actual installed capacity will be higher. So therefore, 13 gigawatts under bidding. Okay. We are looking at a pipeline of about 40-45 gigawatts, which has nothing to do with the reverse auction. Nothing to do with the reverse auction, I repeat. The current run rate in the country in the last 5 years has been anywhere between 1.5 to 2.2 gigawatts commissioning capacity. Last year we did 2.2. This year we're likely to do 3.5 gigawatts. So even if we achieve 8 gigawatts, which is our aim at some point in the future, we are talking about 5 to 6 years of pipeline available for the sector, wind bids, which has nothing to do with the reverse auction. Absolutely nothing to do with the reverse auction. Therefore, today issue is not about the order pipeline. Even now coming to our own company, Suzlon, today we have more than 3 gigawatts order book, which is the highest we ever had domestic order book in the history of the company. And there are many more orders which are under discussions today, in which you will see the pipeline being announced from time to time. Therefore, I think as a country today, order intake is not an issue at all for the next few years. What is important for us is to spend time on concentrating on execution capability increase, so that from this 3.5 this year, how do we go to 6 gigawatts, 8 gigawatts? That's the issue for the sector.
So what do you think, got the MNRE to actually speak about reverse auction than just, you're putting all these facts on the table? Because their letter mentions, in view of undersubscription and higher tariff discovery in recent wind bids. What do you think was the reason for this low bidding and much higher bids or low participation? Why is the industry participating lower? Is this because of lack of capacity and perhaps focus on execution? In that case, then, this should not impact the industry as much.
It is not going to impact the industry. I just repeat again. First of all, the reverse auction notification, what is given is only for the pure wind bids. Okay. Exactly. In the current 15 gigawatts of bids announced by the Government of India, only 2 gigawatts is pure wind bids. 13 gigawatts is FDRE, RTC, or the hybrid bids, which has a wind component of about 13 gigawatts, which is not impacted by this because reverse auction will always be there. Why the undersubscription happened this time was because they came up with the state-specific bidding. It is not a pan-India. There are so many orders today already given. As I said, that 12 gigawatts under execution, there's another 10 gigawatts. They won the bid set to finalize the OEM. Everyone is grappling today with the execution things. How do we ramp up execution? So therefore, more concentration there rather than actually flocking for the bids. That's the reason there is an undersubscription to the extent of only one single bid. Only one bid happened till now after the reverse auction came in. So it's nothing to do with why there is no interest, because there are enough orders with every IPP. There are enough orders with OEMs like us. So that is the reason why you're seeing undersubscription.
No, Mr. Chalsani, take your point. We were speaking to one of your peer companies from your sector, Inox Wind, and I think they made the same point that a dearth of bids is not an issue at all. I mean, there's enough and more work to go around. But just for the sake of clarity, you said that 45 gigawatts of pipeline is coming up, which has nothing to do with reverse auction. How much of this is pure wind? What I'm trying to get at, let's say for a company like Suzlon, if we talk about your bid pipeline, right now, how much of that pipeline is already coming through reverse auction and how much may come through reverse auction? Because that is where the question comes up in terms of how competitive those reverse auction bids would be. Can you give us the breakdown?
All the numbers what I spoke, because there is no point in talking about other solar or other storage. Numbers, every number I gave you is only for the wind component. When I said that 12 gigawatts is under execution, 12 gigawatts of wind bids is under execution. When I said 10 gigawatts of orders have been won by various people, that's only the wind component I'm talking about, which is the right to finalize the OEM. 5 gigawatts from the C&I segment, which is under discussion, is wind. So 15 gigawatts under discussion with OEMs is wind. 12 gigawatts under execution is wind, which makes us 27 gigawatts. The bids which are announced today by Government of India, when I said 15 gigawatts, in that 2 gigawatts are taken away the pure wind. 13 gigawatts is what is FDRE. In fact, 10 gigawatts of that is FDRE. As I said, FDRE, we need to understand is that if there is a 1,000 megawatt FDRE bid, while it will have a wind, solar and storage capacity, because of the FDRE nature, actual installed capacity of wind for 1,000 megawatt would be 1.2 to 1.3 times. That's why in this 13 gigawatts of not pure wind bids, there are FDRE and the other bids, the wind component would be 13 gigawatts. I'm only talking about the pipeline of 40 gigawatts for the wind. These are all the facts in the public domain. There is nothing which is exclusive information to the Suzlon.
Okay. Mr. Chalsani, by the way, as we speak, there is an order which has come in for you. 72 megawatts of order from Juniper Energy. This would be worth how much, sir?
You will see many more. Order pipelines we announced last week.
This is worth how much? 72 megawatts?
I would like to get the numbers because the guidance generally we given earlier also is that normally on average ASP is 6 crores per megawatt.
Okay.
And sir, just to understand that point, right now your total bid pipeline, how much is anyway happening through reverse auction? Can you just explain the mechanism, the total bid pipeline at Suzlon at the moment?
Today, as I said, all the bids which are announced is 15 gigawatts, which are yet to be, means like bids are announced, they're at the different stages, but not finalized yet. In these 15 gigawatts, 13 gigawatt bids are FDRE, round the clock or hybrid bids, 13 gigawatts. Only 2 gigawatts is a pure wind bids. These 13 gigawatts already have reverse auction. They had earlier, they will continue to have reverse auction. There is no change in that. In that 13 gigawatts, the wind component would be 13 gigawatts.
Thanks a lot, Mr. Chalsani, for joining in and giving us this sort of clarity. The stock, of course, at the high point of trade, not only the clarity, the order win also has helped up around 5%. A big mover, Suzlon, out there. And he said that it's about 6 crore per megawatt. A quick calculation tells you that the value of this order that they've just won from Juniper would be close to around 435 crores. Let's get Mitesh back in. Mitesh, your 10 o'clock views for the market among the stocks that have moved. What's your pick?
So I think, today the ferrous metals are back into action. I have a buy on Steel Authority, SAIL India with a stop at about 138.5 and a target of around 152 can be looked at. And the other one which I like is PEL, trying to make a fresh swing high. I would recommend a buy with a stop below 210 for targets of 223.
Okay, all right, Mitesh, I will speak with you soon again. But we've got the market, which is up 25 points. A decent looking screen overall. We'll take a break here. We put the focus back on the commodity screen. Manisha is going to be here. Help us do that in just a bit.
Welcome back. Let's straight away go to the commodity markets now. Manisha is here with the latest cues. Manisha, what's catching your eye this morning?
Well, it's an all-time high in gold. I mean, this is something that we've been watching for some time, and the kind of targets that the banks have been putting out for the end of this year has been done in the first 2 months of this year itself. So it's an all-time high in gold in the global markets, in the Indian markets as well. In last 1 month, we've seen 6% of gains come in for gold. It has been a 19% of a jump up in one last year that the gold prices have seen. And much of those, of course, coming in the last few months itself. For the Indian markets as well, we stand tall at 65,000 rupees per 10 grams. I mean, if you bought gold, if you bought those recent tranches of sovereign gold bond, you already are sitting on a lot of returns and profits onto this one right now. We have seen prices gain up on back of various factors here, but it's not just gold. I mean, take a look at silver. That surged above $24 an ounce. It's a 2% gain onto this one. This is after 5% of gains in the previous week as well. Within the precious metal, everything seems to be glittering. So platinum gained up by 3% overnight. Palladium is trading at a 7-week highs and 5% of gains coming in for this one as well. So every single precious metals in the PGMs group is doing quite well right now. Well, it is about the bets on easing in sense of monetary policy in US. The kind of statement that we heard from the Fed Chair Powell yesterday do indicate that there is going to be interest rate cuts by the second half of this year. And that is what the markets are taking in. Well, apart from that, the traders already are putting in a 70% chance or a probability of a rate cut in the month of June itself. There is a lot of election uncertainty around the world. There are at least 7 to 8 countries going for elections. More importantly, India and US as well, and that would continue to support. There is a lot of safe haven buying that we've seen come in from traders. The central bank buying has been at record highs in 22 and 23 and 24. The first 2 months of the year have been on the positive side also. And then there are funds. 80% longs, historic longs is what we are looking at. So there is this smart money as well moving in case of gold there. I want to show you in what we've done in sense of prices. So all of last year saw 5% of gains, and in this year until now we've seen 5% of gains come in for gold prices already. And when you look at the gold outlook for 2024, I mean, I've been putting it for some time now, and it's quite a number that we've seen surpassing every single day in the last 5 or 6 sessions that we've seen in sense of gold prices. So ABN AMRO, UBS, Commerce Bank and TD, Goldman Sachs as well for that matter, the kind of forecast that they put for 2024 has already been taken off and achieved. Now moving on, there are more bullish forecasts that are coming in from Saxo Bank, from UBS, XM Australia, which are now talking about 2200 to 2250. I mean, there are now forecasts that once these levels are taken off as well, you could be looking at 2300, 2400. I mean, there is a long list really once a lot of levels then get done on charts. So we clearly are watching out for that.
All right, Manisha, thanks very much for that. That's very sort of interesting stuff on commodities. Markets, by the way, quiet, 20 points, 22,500 nearly is where we're at. We'll take a quick commercial break here. On the other side, our special segment, Indianomics. Lata will get chatting with Aditya Bagri, head markets, and Surendra Goyal, head equities research, both, of course, from Citi India. We discussed Citi India's growth outlook for 2024. Stay tuned.
welcome to this very special edition of Indianomics. The Indian economy and equities are possibly at an inflection point. While GDP growth is almost touching 8% this year, at least the first 3 quarters have, the equity markets have been notching fresh highs with some regularity this year. The rupee is a picture of stunning stability, and Indian bonds have already rallied 5% this year and look set for a big year ahead, what with inclusion in not just the JPM index, but also in the Bloomberg index. In addition, there is an important election round the corner, which promises to usher in another term of stable politics and policy making. It's a great time to have an investor conference, and that's exactly what the Citi India team has been busy with. Their investor conference comes up on the following Monday and Tuesday. Joining me to speak about the conference and their view on India's markets and macros are Aditya Bagri, the head of markets at Citi India, and Surendra Goyal, the head of equities at Citi. Gentlemen, thank you very much for your time at what should be a very busy last working day before your conference begins next week. So thank you for sparing your time.
Thank you for having us here.
Sure. Well, Aditya, for starters, I mean, I'm excited by the fact that now 2 indexes include us. What's your view actually on yields itself? It looks like everything is going for a bond investor.
I think very true. To be fair, Lata, I think we are very constructive on Indian bond yields. I think starting from the fiscal deficit number as well as the gross borrowing that was announced by the FM, I think it took the market by surprise, and we did see the market react to it, right? We were trading around 715, 720 in the 10-year IGBs. Now we are closer to 705. I think the 14.1 lakh crore of gross issuance can easily be absorbed by the market. Plus, at the back of all these bond index inclusion, we're expecting just from a passive flow almost $25 billion to come in, right? And if you include the active flows, maybe closer to $30 to $35 billion. So we think that bond yields, just given by the demand-supply dynamics, can go down to maybe 680. And if towards 680,
okay,
right? In fact, we think if RBI starts cutting rates or gives an inclination that rate cutting is on the horizon, I think it can go down even further to maybe 6.5.
Okay. Well, we had a report from Samiran, and he was on the channel. He's not expecting it till, I think, October. So, I mean, there is some time. But nevertheless, 680 is mouth-watering for anyone looking for CapEx, plans. But that's the point, Surendra. Are you seeing enough CapEx plans? When you approach the equity market, would you pick CapEx candidates?
Yeah. So, yes, we do like that sector. The only thing we would add here is that the recovery is gradual. Okay, it's a slow, gradual recovery, but all the preconditions for CapEx that are required, they have all been in place, right? COVID kind of pushed out things a little bit because capacity utilization across industries went down. But now we are kind of back up there. So definitely feels like a much better place to be in. Like, what are all the usual preconditions that are required? They're all in place. Capacity utilization across the system has been increasing. The only thing we need to keep in mind that it's unlike the previous cycle, which is what people always end up comparing it with, right? Where we had like 4 or 5 very high years of growth.
Of infra growth.
Infra growth. So I think it will be a lot slower and moderate, but I think everything is moving in the right direction.
But,
and some of these businesses, like more as stocks, they have gone through a fairly prolonged slowdown. So as they come out, the growth is also accompanied by operating leverage, which from an earnings perspective is translating quite nicely for investors. And that is where we continue to like the sector.
Okay, so what would you pick? Would you pick stocks like L&T? I don't know if you're allowed to name names, but is it that kind of stocks? The PSU utilities are doing very well. Which is your, where would you train the viewer's eye?
Yeah. So we actually like both the segments of the market. If you look at our reports for the sectors where we have overweight stance, both of these sectors figure. Okay,
and it's CapEx and...
as well as PSU utilities. And I think it's a combination of multiple things. I think it's where valuations are in context of the broader market, the kind of growth outlook, right? I think when you put it all together, these sectors still compare quite favorably. And some of these sectors, like PSU utilities, for example, also benefit from the fact that for multi-years, the level of interest in these sectors has been low. So they started with a fairly high level of under-ownership. And as people kind of kept bridging that under-ownership, the stocks have really done very well.
So, it's defense, power and railways in the PSU sector that have done well. You like them all?
So again, we are a bit selective, but as sectors, yes, we do like all of them.
Okay. I mean, the big fear of small caps, would you worry about which kind of PSU utilities you're picking up?
No, absolutely. Which is why I mentioned the point that we are selective. We would be careful because definitely in certain pockets in the small cap and micro cap space, you feel that there is a lot of optimism getting priced in. Okay. And I think to that extent, one needs to be cautious here. If you look at the kind of flows that we have seen in SMIDs in the last 14 months or so, they have been very strong, right? Yes. So definitely there are pockets where we feel there is too much optimism. The fact is that SMIDs have also delivered better earnings. Okay. So to some extent it's justified, but there are pockets of exuberance which we will be careful about.
Okay. Well, Aditya, tell me about the cost of capital for corporates. If the Indian government is going to borrow as low as 6.8, do you see a rush of corporate bonds? Will that market become active again?
So I actually think even currently, right, if you look at the corporate bond spreads, they're quite tight. The 10-year PSUs are trading at almost 40 basis point spread to Government of India bonds. So at 705, PSU bonds trade at around 725, right? Even NBFC's name are trading at around 750 to 760. So the corporate bond spreads have stayed tight after COVID, right? When there's a rush of liquidity in the system. I do think
as you get to 6.8, right, then you're going to have even more attractive yields for.
Absolutely. I think from a spread perspective, maybe you will see some widening because all this inflow that is going to come and the demand dynamics which is going to be there is going from Government of India bonds, right? Having said that, I mean, corporate bonds are also going to benefit. There will be a crowding in, right, of investment in corporate bonds because a lot of the supply will be taken over by foreign investors. And so from a local investor's perspective, they'll be able to deploy that in corporate bonds. So I do expect corporate bond yields to also come down, maybe not as much as Government of India bonds, but definitely yes.
Okay. What about the rupee? If you're going to have $40 billion, counting active and passive and Bloomberg and JPM, right. Do we see some? I mean, we have seen, which is a usual scene in the Jan-Feb-March quarter. At least we are starting to see 82 point something. Right. But does it get any stronger?
So again, very constructive on rupee side. We don't know if there will be a lot of appreciation, right? We actually think that from a balance of payment perspective, maybe we will see about $45 to $50 billion of surplus for India next year. Having said that, we think RBI might look at adding back to the reserves, right? Keep growing it. So you might not see a big appreciation in rupee, but it might just trade within this range.
Okay. Well, actually, I've forgotten about your conference. Surendra, what can you tell us about the conference in terms of its attractiveness? Are you seeing a fresh batch of FPIs or funds, sovereign wealth funds interested? What's the audience like? Or what's the interest like?
Absolutely. So we are seeing very high interest. And I'll maybe share two things. Firstly, about the conference. We have around 200 clients registered for the conference, out of which 80 are investors from overseas. Oh. That kind of tells you about the interest. And the second thing I would mention is that we, even like when I was in the US, say a couple of weeks back, we are seeing a lot of interest from international funds. And when I say international, what I mean is world ex-US. Okay, and in this benchmark, India is now 5% of their benchmark, which say 3-4 years back used to be 2 percentage points. And in the same small cap benchmark, India is now 8% of the benchmark. And these are investors who may not have spent a lot of time on India in the past because the exposure or the percentage was relatively small. So we are seeing a lot of interest in India, and which is kind of reflected in the conference as well. The number of investors, the kind of investors. The other thing I can tell you is we are getting a lot of people who are either looking at India for the first time or kind of were looking at some other EM or Asian countries mainly. And now because India is becoming more important, they are also spending a lot of time in India. So I think it's a combination of all those things.
Okay. Aditya, you want to add anything in terms of specific themes that you all may be exploring in the conference?
So, just to add to what Surinder said, right? I mean, last year we actually did these road shows all over the world, talking to both investor clients as well as corporate clients and talking about the whole India opportunity.
How is it different then?
So I don't think I have seen this level of interest in India in last 20 years that we saw this year or last year, right? Partly, I think it's just because how strong the macro fundamentals are in India, partly because everyone is looking at China plus one strategy, they're looking at diversifying out of China, and India is one big, strong market that they're able to see. Just one more thing I do want to add, says Surendra, and you brought up the conference. We are also expecting Jane Fraser, our global CEO, to attend this conference. So yeah, that just shows interest that we have not only from
and the importance given to
exactly
the India equity story and the India economy story. That sounds very interesting. Obviously, India is important, which is why the big people also come to attend an India equity conference. We have to take a break, but I have lots more questions for Surendra and Aditya on how the global scene might shape up and whether the Fed can improve or detract from our picture. All those questions will be, for the full show, will be available to you after the market hours today. But for the moment, it is a break and chart busters for Bazaar viewers.